Welcome back, everyone. Today, we're strapping in and navigating the muni market maze. Look, if you're gearing up for the Series 7, you already know the test writers absolutely love setting traps in the municipal security section. They want to trip you up on the math, the taxes, and the weird little rules. But we aren't going to let that happen. We're going to break down the pricing, the yields, and the gotchas so clearly that you won't just recognize the answers, you'll be spotting the traps from a mile away. Real quick before we jump in, this explainer is brought to you by CertFuel. Because let's be real, just staring at a dry textbook isn't going to cut it. They've got a full Series 7 course with adaptive study quizzes, smart flashcards, and unlimited practice exams that are weighted exactly like the real test, so it actually figures out what you don't know and helps you fix it. Check them out at CertFuel.com. All right, let's get into it. So imagine Carla, the customer, just bought a house from Riley the rep. She moves in, walks right into the kitchen, and bam. There's a fresh, half-eaten pizza sitting on the counter. And instead of tossing it, she actually hands Riley $10 for the slices he didn't eat. Sounds completely absurd, right? But honestly, this is exactly how accrued interest works. When Carla buys a municipal bond from Riley in the secondary market, she's stepping right into the middle of a payment cycle. The issuer is going to send Carla the full coupon payment on the next date. But hey, Riley held that bond for part of the time. So Carla, the buyer, has to reimburse Riley, the seller, for the interest he earned before she took over. She basically buys his leftover pizza and then makes her money back when the full coupon finally arrives. Okay, so how exactly do we calculate that leftover pizza? Well, for municipal bonds, the MSRB calculation of interest rule makes life weirdly simple. We use a 3360-day count convention. Memorize those numbers. For munis, every single month has exactly 30 days. February, 30 days. October, 30 days. And a year is exactly 360 days. You just calculate the accrued interest from the last payment date right up to, but not including, the settlement date. And boom, that brings us to our first massive exam trap. The test writers are going to try their hardest to bait you by mixing up bond types. So compare these side by side. Municipal bonds and corporate bonds both use that totally artificial 3360 rule we just talked about. But U.S. government bonds, they live in the real world. They use actual days in the month and a 365-day year. Do not let them trick you into calculating a treasury bond with a muni day count, or vice versa. It's a classic trap. Now, what happens if a newly issued bond has a kind of weird schedule? We call this an odd first coupon. Usually, bonds pay out every 6 months, right? But if the very first coupon period is longer than 6 months, literally called a long first coupon, it naturally accrues more interest. If it's shorter than 6 months, it accrues less. It basically just adjusts the exact amount Carla owes Riley at settlement. Super straightforward. Okay, pause the explainer. Let's do a quick pattern interrupt here. We just established Carla pays Riley for the accrued interest. But what if the municipal bond Carla is buying is currently in default? Like the issuer has completely stopped making payments. Does Carla still have to pay Riley for the accrued interest? Take a second, pause, and lock in your answer. And the answer is no. Absolutely not. If a bond is in default, it trades what we call flat. That literally means it trades completely without accrued interest. Because think about it, Carla isn't paying for pizza if the pizza box is totally empty. If the issuer isn't paying, the buyer doesn't pay the seller. Oh, and by the way, income bonds, which only pay interest if the issuer actually earns enough revenue to do so, those also trade flat. Now, let's talk taxes, specifically how the IRS treats discounts. When you buy a bond below par, it's a discount bond, but the exam absolutely loves to test the difference between an original issue discount, or OID, and a market discount. Check this out. If the bond was issued at a discount right out of the gate, an OID, the IRS says, cool, that discount accretes annually and is treated as tax-exempt interest income. Boom, tax-free. But if Riley buys a bond in the secondary market that dropped in price because interest rates went up, that's a market discount. That accreted discount is taxed as ordinary income. Say it with me, market discount is taxable. Do not get those confused. Okay, let's flip it and look at another massive exam trap. Cue Sam, the supervisor, rushing in to stop Riley from making a huge mistake. Say you buy a municipal bond at a premium, so above par. You have to amortize, or basically reduce that premium over the life of the bond, which lowers your cost basis each year. So Riley's thinking, awesome, my basis is going down, I'll just claim that as a tax deduction for a loss. And Sam slams his hand on the desk and says, no way. On a tax-exempt muni, you can never deduct premium amortization as a loss. Why? Because the interest you're getting is already tax-free. The IRS isn't going to hand you tax-free income and a tax deduction on the exact same bond. At maturity, your adjusted basis hits par, and there is zero capital loss, period. Let's shift gears for a second and talk about price action. We know that when interest rates move, bond prices move in the exact opposite direction. But which bonds react the most violently? You need to memorize this shortcut formula. Maximum volatility equals the longest maturity plus the lowest coupon. Think about the why here. A 30-year bond paying only a 1% coupon gives you almost zero cash flow today. Literally, almost all of your return relies on what happens 3 decades from now. That makes it incredibly sensitive to today's rate changes. So if you want the wildest roller coaster ride, you're looking for the longest time horizon coupled with the lowest payout. Which brings up a crucial point. How do you quote yields to your customer when these bonds are callable? MSRB rules demand you quote the yield to worst. You always have to show the customer the most pessimistic scenario. So if Riley is selling Carla a premium bond, the worst case scenario is that the bond gets called away early. That means he absolutely must quote the yield to call. But if he's selling her a discount bond, the worst-case scenario is that she's stuck holding it the whole time, so he must quote the yield to maturity. Just remember the golden rule, always quote the lowest possible yield. All right, time to pause the explainer again. Get your scratch paper ready because this is probably the most frequently tested math concept in the entire muni section. Here's the setup. Carla is in the 32% federal tax bracket. She's looking at a tax-free municipal bond yielding 4%. What is the taxable equivalent yield? Meaning, what would a taxable corporate bond need to yield to put the exact same amount of cold hard cash in Carla's pocket? Pause the explainer, do the math. Okay, let's walk through it together. Don't let the numbers freak you out. The formula is simply the tax-exempt yield divided by 1 minus the marginal tax rate. Step 1. Take the number 1 and subtract Carla's tax bracket. So 1 minus 0.32 equals 0.68. Step 2. Take that 4% muni yield and divide it by 0.68. Run that in your calculator and you get 5.88%. What does that actually mean? It means Carla would need to find a taxable corporate bond yielding a whopping 5.88% just to match the take-home pay of that 4% tax-free muni. But wait, because the test writers have one more sneaky exam trap for this exact formula. What if Carla lives in New York, buys a New York State muni bond, and pays a 6% state tax? Well, for in-state munis, they are triple tax-free. So in that scenario, you have to combine her federal and state tax rates in the denominator. Her 32% federal plus her 6% state means you'd subtract 0.38 from 1. If it's an out-of-state muni, you only use the federal rate. It's a huge difference, so do not let them catch you slipping on that state tax. All right, deep breath. We are going into our high-speed rapid recap. Treat these like mental flashcards. Ready? Let's go. Number 1, municipal bonds use a 3360-day count. Every month is 30 days, no exceptions. Number 2, premium amortization on a tax-free muni is never, ever a deductible loss. You don't get double tax benefits. Number 3, an original issue discount is tax-free, but market discounts accrete as absolutely taxable ordinary income. Market equals taxable. And finally, number 4, callable bonds always quote the yield to worst. The lowest possible yield wins the quote. Let's bring it all home with one final test of your new knowledge. Carla's portfolio currently holds 2 bonds. One is a 10-year bond paying a 5% coupon. The other is a 30-year bond paying a 2% coupon. Suddenly, the Fed hikes interest rates to the moon. Based on the volatility rules we learned today, which of Carla's bonds crashes way harder in price? Think about the timeline. Think about the cash flow. I'm actually going to let you solve that one on your own to prove you've officially mastered the muni market maze. Keep studying, stay focused, and I'll see you in the next explainer.